Hey guys, Mike here. So hope everybody's doing well today, and obviously you have some great questions about will the tax bill provide liquidity or not. We're going to talk about that. Another question in here, which I had to go actually do the research on because I didn't know it, was about baby boomers who are retiring, and there's a boatload of them, and what that's going to do to the market as far as how it's going to affect it, because I didn't know the stats behind how much of the stock market they actually own and wealth and all that stuff and how it's going to affect everything. I'm like, woof, okay. Because we've never had to deal with that before, right? We've never had a generation that size all of a sudden over a 10-year span just going to start flooding into retirement, which means they're not contributing to their 401ks. They're actually going to be drawing out, not putting in, okay? And that's a pretty big deal. And so I'm definitely going to go through that. Plus some other things we'll talk about in this video right here. And so let's just get right into it. Again, hope everybody's doing well today. First one here, do you think the tax cuts will provide a boost to the market, or will it be a sell the news event? Well, I'll tell you this right here. We look back the last time they did the Trump tax cuts, I guess it's called Trump tax cuts 1.0, then you can see right here we had a huge move up, and then we just fell off a cliff. So it was a big move up as soon as he signed it into office. Actually, a couple of day delay there, but as you can see, and what's funny about this, you know that big drop right there? I was like, what caused that drop? See if this sounds familiar. I thought you should get a nice laugh out of this because I did. The market began its drop on January 25th, 2018, in part due to the fear of rising interest rates and the potential for a more aggressive Federal Reserve. This fear was fueled by a strong jobs report and the prospect of rising wages, which raised concerns about inflation. Additionally, there were concerns about a slowdown in global economic growth and the potential impact of tariffs. Does that sound familiar? And then we went on a big run, and then of course we basically did a 19.5% drop from October 2018 to December 24th of 2018. So again, we're kind of comparing this year to that year. So far it's kind of played out almost in a different way, but still, you know, when you look at this, is it going to provide, it's different forms of liquidity, right? Will you think it provide a market boost? You would think. Okay, so remember, we're extending tax cuts, so whatever your taxes were shouldn't change on that part. But then, of course, you know, they're going to be putting in tax on tips, overtime, and there's going to be restrictions on all this stuff. So don't just think you're like going to be getting no tax on tips and overtime, free and clear. You know, the tax code is very complicated. There's always, little things here and there on this, and also they have stuff for small businesses. Supposed to increase that. But, and then of course what really matters is where's the tariffs at, right? If we negotiated stuff down or not, because then what happens is it almost becomes a squash, right? Where you just kind of, you get money back on this one, but you're spending more money on this one, so then you get nothing, right? And so that's a whole different ball game. So that's what we got to look at as well. And so we'll see what happens. I mean, in theoretically it should, okay? Theoretically it should provide a boost to the market. That's what it's done in the past. Okay, it was just a little one up there. But as we've seen, tweets are more powerful than anything else at this point in time in this market, as you've seen. So that's kind of where we're at now. Let me know what you think about that. Whether you like what's in the tax bill, don't like it, all that good stuff. Now, next one says, with yields still climbing and keeping borrowing rates at elevated levels, how are companies continue to stay in business and beat earnings? What gives? Thanks. Well, remember, here's the big thing to look out for. And this is what the bond market is kind of telling us. Strangely, American companies will soon face higher interest rates. More than $2.5 trillion of fixed-term corporate loans are due to be refinanced before the end of 2027, with $700 billion due in 2025 and more than $1 trillion in 2026. And of course, that does not, include our government debt we have to refinance, of course. But going back to your question, remember, who's really beating earnings right now? It's tech companies, a lot of them, right? And you got, here and there, some others are beating them, whatever, but because they have a lot of cash, because we have a weaker dollar. So really the people who do global sales, right? Global companies, when they go and try to convert those sales, those dollars back into American dollars, it's actually helping having a weak dollar. It helps them on their earnings, okay? So that is one thing, okay? And when you're talking about like the stock market versus the economy, all that stuff, remember, also these companies are buying back crazy amounts of stock as well. So that's helping push the stock market up, okay? But there's plenty of companies. Look at this, it's the small companies you're not hearing about, right? There's plenty of small companies, especially, if you look at companies that aren't even on the stock market. Like, I mean, you just talk to somebody who owns a small company. I mean, I was talking to somebody who said, I was on my son's field trip, chaperone, talking to this guy who's in the construction business, and he owns a small company. He said, yeah, it's killing me right now. I'm trying to keep my workers, but other smaller people or companies are laying people off. I'm just trying to hold on to what I got because, you know, lumber prices are going up, all this other stuff. And so he's like, it's tough. It really is tough. Plus the real estate market, you know, not exactly the best right now too. So, you know, it's rough. So, you know, and really you hadn't, again, I keep telling you, you hadn't even felt what is actually going to take place with, you know, the rising yields are one thing, but usually, you know, they'll get to a certain point and they'll come back down, they'll get to a certain point and come back down, whatever. If they break out, I mean, really start going back to, especially the 10-year, back to 5 and over that, oh, you're going to see a whole different stock market and a whole different deal when it comes to earnings. There's no doubt about that, okay? Because I don't think we can sustain that. Did I say sustain? There we go. Did I say it right that time? Sustain that, of course. But, you know, it's not just that. It is tariffs and higher prices and of course, the borrowing costs being up and all that good stuff. But you might have noticed, like, what was it, a week ago when they started tweeting out about, you know, the tariffs are going up 50% on the EU. And what happened to yields? They dumped. What happened the first time when they did the tariff stuff? They dumped, right? From February, the yields dumped with the market, okay? Because it was this growth scare, right? And so that's one way to bring down yields. And that's why I said they can dump fast. If there's a growth scare, yields will come down. The market will probably come down with it. But, you know, that's kind of how that works. So we'll see. I mean, but that's, you know, let me know what you think about that. I know I was all over the place on that. But, you know, it's about, you got to watch what companies are actually beating earnings and why they're beating earnings. Okay. That's really the big thing. And start paying, you know, a lot of attention if you're looking at economy wise, mid, small cap companies. That's what you want to be looking for. I mean, there's a reason why the Russell 2000 is way off its all-time high. And the Qs and the SPY at one point in time were sitting there at less than, you know, 5%. You know, so anyway, next one here comes from Brian. He says, what do you think about the boomers leaving the workforce? Their capital is going from risk/401ks to treasury bonds and labor disappearing. How can the cost of capital go down? Should we expect higher interest rates? How much of the stock market is owned by boomers? And should we expect the forced selling of boomers 401ks as they finish leaving the workforce over the 5 to 10 years to reduce stock prices? Well, that's a bunch of stuff right there. And when I started digging into this, I mean, like, for example, as of Q4 2024, baby boomers own 52% of the net wealth in the U.S. When trying to find out, like, what they own as far as stocks, you can kind of see right here. I don't know what it is exactly. I've seen anywhere from 30% to 45% of stocks, but it's pretty obvious the wealth gap. I mean, look at that. Unbelievable. There's never been a generation to build wealth like this, because remember, they could buy houses back then. Remember, Warren Buffett's still in his same house. He paid like, I think he paid $30,000 or something for that thing. It's worth millions right now. But again, my grandpa paid like, I think he paid $25K for his house, and when he died, it was like worth $400,000. So I mean, that's like whatever X that is, you know. So that kind of stuff. And we're up here paying how much for houses right now? You know, you think they're going to be worth 4X when you go to sell? No, it's not going to happen. But you just look at that, the gap, right? So it's all about Gen X, and it's all about the baby boomers. The other generations, not so much. Not about millennials, and not about the silent generation, I guess, when you look at that. But remember, they're also going to be passing this wealth on, right? So the estimated wealth to be inherited through 2048 by generation, Gen X is going to inherit about 39 trillion, 46 trillion going to millennials, right? So it will be handed down, but until that happens, of course, people live longer, so they will start becoming takers and not actual givers when it comes to putting money in their 401k for sure. And somebody actually wrote an article on this about a year ago. It says maybe baby boomers won't tank the stock market by cashing out. And so, you know, the common wisdom has been that retirees will liquidate their holdings and securities and real estate to fund their old age. And so this could happen, but I used to work with elderly people in a job I had. My wife still does. And the one thing they always would say to me is, well, you know, this is for my kids. And so that's the one thing they always have in mind. They're not there trying, and think about this, how much do they need, right? Most people, I mean, think about your grandparents. I think of my grandparents, I think of people I worked with in the past. Like, you know, they ain't traveling every day. You know what I'm saying? I mean, most of their day is literally, my grandpa especially, he had money to travel, but it's read a newspaper, take a vacation every once in the blue moon. But their, you know, their bills are very limited because most of their houses are paid off, right? They're going to pull Social Security, and because their expenses are so low for most of these folks, they're just going to live off that. And then, of course, people will end up inheriting it. The big thing is they're not contributing anymore, okay? But the younger generation that's come on now is also, you know, we got plenty of people still coming into work right now, contributing. So the market's going to find a way for sure to stay up. There's no doubt about it in my mind. I mean, my father-in-law, for example, he's been retired for years. He lives off dividends. He's never cashed out anything, never sold anything. He just lives off dividends. And so that's what he does. You're like, oh, cool. His house is paid off. His truck is paid off. So it's kind of a big difference. I think people make it out to be like they're going to retire and then go cash it all out. And remember, they're very tax savvy. They don't want to pay taxes. You know what I'm saying? It's a lot. If you just cashed everything out, oh, the tax bill would be huge. So they don't want to do that either. So I don't believe for a second it's going to taint the market. It may put a little stress if the boatload of them just start retiring like crazy, or something happens to Social Security. That would be another thing to think about. But no, I mean, the market has lived through people retiring before. The market's going to continue to live on. It will find a way. That's just the way it is. You know. So that's my opinion. Let me know what you think. For sure, and all of it's a guess. We all know that, right? We don't know. Now, next one says, why is Japan's economy doing so badly? I'll read this to you because I don't live in Japan, but obviously they face a lot of issues some other places face too, right? I mean, they got a contraction in GDP, stagnant consumption, rising living costs, low birth rates. I mean, low birth rates are hitting a lot of countries. And I told you about our birth rate and everything, and China's birth rate and these larger economies. And that's why immigration is important, but Japan don't have a whole lot of immigration. So they got labor shortages. Does that sound familiar? An aging population. Does that sound familiar? And so, of course, that's putting strain on them. You can see right here, like Japan's economy shrinks for the first time in a year. And so, you know, not a great thing. That's why the rates are just, man, going through the roof. Like, you know, nobody's buying their 30-year, 40-year type stuff. Nobody's even wanting to try to do that. And so, like a lot of countries, even us, like they've taken on a boatload of debt, and you can just see I think I covered this in another video, but the GDP ratio, it's like 263%, which is absolutely insane. Now, why this is important to us is very simple, because Japan is our #1 foreign holder of our debt. It's over $1 trillion. Okay, China's second, UK. If you put like UK and then like all of the EU together, they actually hold more than Japan, but separated out by country, and it's Japan. And of course, as you can imagine, when we run debt like this, a deficit like we do, we can't afford for our #1 foreign holder of debt to have issues, because if they have major issues, they would have to dump our bond and treasuries to raise money. And so that's not what you want to do. And so they got a lot of problems like everybody else. But the biggest thing is, remember people had to bail out Greece? I told you, people are going to come running, especially us, hopefully, to bail out Japan. Okay, they're an important part, you know, as far as trade, as far as them buying our debt, which is #1. You know, if you're a company, and think about that, and you have this one person or one company that buys a lot of your debt, and all of a sudden something happens to them, is that going to affect you? Absolutely, it's going to affect you. Okay, and it'll create panic, a lot of panic. Like, you thought there was panic in the bond market and we were going down. Like, if Japan got in trouble, yeah, that panic would be huge. Okay, and it would happen overnight. Obviously, they're open different hours than we are. So by the time we woke up, you would see a boatload of red in the market. And I assume, hopefully, the president will be smart enough to know we got to step in and help them out. So, you know, to get them back on track. So that's just the way it is. You can't lose them. And they're not an enemy or anything. I mean, we have military bases still there and stuff. So, and when it comes to having to set up for, you know, war, if we had to go to Japan, where do you think we're coming? Sorry, not Japan, but China. Where do you think we're coming from? Okay, they allow us to kind of keep control and be in that region and be ready to go at all times. So just FYI, they're important on many levels. Okay, and they're really nice people. I enjoyed being over there when I went over there twice. Now, next one says, what are the most important indicators you use in investing, if you don't mind sharing? I just keep it simple, man. So I like my moving averages. I like my fibs. I like levels. I like especially the imbalances or the fair value gaps, whatever you want to use. But, you know, this is like Google, and I'm just looking for, like, especially on the investing part, right? So you can really dollar cost average down, or even up if you had to, obviously. But, you know, when you look at this, you find a weekly, especially a monthly fair value gap, you're going to get, that's where liquidity is going to draw to. It's going to bounce. If it happens to line up with a level, that's even better. My fibs, you know, I love that. They're buying a discount, because it increases the odds you're going to get a bounce from that level. And so, again, that's what I like to use when I'm putting these together. I think I'm even did a video for you guys that came out last week or come out this week about how I came up with these levels and stuff. And I showed members before President Trump held up that sign on tariffs and the market just cratered, you know, like these different levels and stuff like that. And some of them hit and some of them didn't. But, you know, that's just what I like to use. So moving averages, fair value gaps, fibs, and then key levels that you can mark out on your chart. Use the volume range, volume profile. If you can't spot support resistance level, it'll pretty much do it for you. And so again, that's what I like to see. And then, because in a crash, the 200 weekly is going to come into play. Okay, that's usually how it works out and stuff. In a recession, especially, it's going to go below the 200 week on a lot of different stocks and everything. You can use the RSI. Obviously, if you ever get oversold on a Mag 8 stock, you want to just buy hand over fist a lot of times because it's going to pay off. Okay, Microsoft got there and just went ham crazy. It hadn't been oversold since like 2010, I believe it was. So it's been a long time. So that's definitely something else to look at. Your MACD, of course, is another one as well. So hopefully that helps out. Last one here says, I'd love to see your list of stock tickers that they serve a unique purpose. Then a brief description may be helpful. My trading view lists are by industry. Being an amateur trader of 2 years, seeing your method may tune me into new techniques. I don't think I'll give you any new techniques probably, but understand I have a lot of watch lists because I have this channel. But a few, and the most important to me, like during the day especially, is I always got my futures pulled up, and you always got to compare. If you're doing options, obviously it'd be SPY and QQQ. If it's the futures, then you'll do obviously NQ and ES. But I like to keep an eye on 10-year, HYG, VIX, dollar, oil. I like to see what they're doing. And right above that, I have the Mag 8, okay, because the market's going to go how they're going to go. So if they're rallying, then obviously I know probably going up that day. If they're red, it's not a good thing. And I'm basically looking for those to turn on top of it. But then looking at other things, I mean, especially I do this everything in the morning anyway for the morning news brief, but I like to know what the breadth indicators actually look like. Again, what the VIX is doing. And then I like to look at the sectors, you know, what's red, what's green, all that good stuff. And you can see like S&P has been really far behind right now just because most of the sectors have been red in the last few days. And this will also tell me, you know, if the S&P is dragging, why it's dragging, okay? Because the Q is what's been leading us up over the last like 3 weeks or whatever. But, you know, you look at then the sectors versus the SPY. This is what I look for when I look at for rotation and stuff. Like this is what I'm looking at. So that's just the ones I look at. You feel free to pause that and copy them if you ain't got them. But that's what I'm looking at. So anyway, hope you got something out of it, guys. Please hit that like, subscribe button on your way out. Thank you about signing up for the membership. Listen to McDonald's combo, only $7.99. It's everything you get with it. And I'll see you guys later.